Okay, so we are on. I'll do a little bit of a reintroduction. So, Phylicia, Co.
No, I like it better how Laura said it, Phylicia.
So, Phylicia Co. from Play Ventures, an early investment fund
Yep.
focusing on games and a little bit more than that.
Yes, that's right. Gaming, game studios, tooling, tech, infrastructure, and everybody's hated word, which is gamification. But
And a little bit of a Web3 as well.
yes, that
A
too.
little
Although
bit.
we won't talk about it here, I think.
Okay. So, Phylicia's a partner. Then we have Dara Leung from Rain Group.
It's been a long day.
It's been a very long day. Now I'm making mistakes. So Rain Group, an investment fund for growth investment fund. And you,
So it's
Rain does many things.
Rain's a merchant bank. We do both M&A advisory and growth fund investing. We have $4.5 billion under management, and we're entirely focused on the entertainment sector. So a big vertical for us is gaming, but we also do sports, film and TV, and music as well.
Yes,
Thank you.
Thank you so much for that. And Maria Kochmola, so you are from the Games Fund and also an early stage fund for games, as the name would suggest. And your focus is perhaps a little bit more in Eastern Europe and Middle East?
Yeah, exactly. So we are focusing on early stages, and we believe that we have a unique access to the Eastern European markets and Cyprus. So this is our key regions, although we invest globally. And mostly we are focusing on content. So we have a small allocation for infrastructure and tools, but our key interest is on games and studio developers.
Perfect. And you're also a partner and a co-founder of the fund.
Correct, yeah.
So how many in the audience have raised or are raising currently from the VCs? Surprisingly little.
That's good.
Okay.
Yeah.
Interesting. So we're going to go through a bunch of different questions, and if they're not shown here, I need to go to my phone.
Do you want to get your phone out first?
There's so many questions that I have to look
Okay.
at my phone. So apologies for holding the phone in my hand. So I think the first question is, what is the difference between an early stage fund like Play and the Games Fund as well and a larger growth fund? So perhaps we start with
Yeah, sure.
Phylicia.
So Play specifically invests in what we call in VC speak as pre-seed to Series A. So pre-seed, just very simply, is pre-product, pre-revenue. Oftentimes, maybe you just have a pitch deck, an idea, a couple of your friends, and you don't even have a company bank account. Like, that's what I'm talking about when I'm talking about pre-seed. And you probably remember those days. Sound a bit familiar.
Yes.
Seed stage, you might have raised a little bit of angel funding. You've built a little bit of a prototype. You have more metrics, but you're not generating serious revenue yet. And then Series A is when you kind of would probably have a little bit further down and start to generate some meaningful revenue. That's the span that we invest in. And then I think after that, that's more Dara's.
So at Rain, we have two separate strategies that invest in gaming. One is a gaming-specific fund. We write checks $10 to $15 million. And for that, it is post-revenue and post-metrics. But it's typically right after the rounds that the Games Fund and Play does. So we speak all the time and try to stay in touch and understand each other's portfolios really well so that when the companies graduate from Play or from the Games Fund, we're ready to intercept them. So the earlier we get to know a company, the better it is for our Games Fund to invest. The next stage is our growth fund, which is our principal strategy. That's where we spend most of our time. We're on the fourth fund, and that writes checks from 50 to 100 million. So that's typically Series C, Series D. Valuations can range from 500 million to $1 billion. We used to think that that would be the last stage of investing prior to an ultimate exit, either an IPO or a sale to another strategic. What we've learned, obviously, is that our most successful investments, even though the initial check size from us is 50 to 100 million, they end up raising subsequent rounds, and those end up being our most successful companies. So the next stage from our fund typically is like a buyout type growth investment from a KKR or Apollo, those that have full buyout strategies, but also have a growth arm within them to help the companies continue growing. And I would say for all the companies at that growth or later stage, it's either close to profitability or post-profitability. And the biggest, most important thing for us is that there's clear product market fit. And with $50 million to $100 million of primary capital, it could really dramatically accelerate growth. And oftentimes what we see as well is because the companies will be investing so dramatically when they receive that size of check, sometimes the profitability dips. So it's not uncommon, even though it's extremely painful for us to present our IC, like a company that's like break even, profitable, and then as soon as we invest, the profitability dips because they're accelerating their growth engine. But that's ultimately what kind of drives to greater and greater outcomes. So I would say that's the difference principally between early stage and growth.
So Maria, talking about like the first stages, so the early stage when you're getting your pre-seed or seed check, at that point, you may have product market fit, but most likely you have a hunch of a product market fit, and the team is a much more important aspect when doing that evaluation.
Correct.
So how do you evaluate a team?
Well, I think that experienced teams and big name teams are an easy target, and most of the investors, they are kind of hunting for this type of opportunities. And personally, I can understand why proven track record matters, but at the same time, I think recently the most interesting ideas we received came from less experienced founders. So I'm not sure of the necessity of such pedigree for the founders. And in the Games Fund, we're trying to stay open to probably less experienced but still outstandingly talented founders. For us, preferably, there should be a mix of experienced developers and young blood. And I also think that we believe in balanced teams. For example, there should be a mixture of different skills in the founding team, from creative to tech and marketing. You were talking about mobile.
Phylicia?
Yeah, I mean, I think I generally agree with Maria. I think when it comes to, I guess, more established genres or platforms, like you want to see that experience, that domain expertise that Laura was talking about. But if it's like something totally new, where honestly we are all equally uninformed, sometimes folks with less experience just have like fresh insights or a very native understanding of the audience of that platform, and they can do really well even though they've never built a game before. They have just kind of more, I guess, hustle when it comes to go to market and how they're thinking about it, because the playbooks don't exist. So there's really no advantage that a more experienced team will necessarily have.
And would you agree with the same thing of like initially it was a lot of a big name, but now you're more varied? Or
I mean, at Play, I don't think we've ever really been big logo hunters because, I mean, I love Riot Games, but, just because you've worked there for 10 years on an established title does not necessarily mean there's a lot of transferable skills there. So, I mean, that experience doesn't help, and I can understand why some investors index on that. I don't think that's what we necessarily look for, but I think in this market, fundraising is tough. It's tougher than it's ever been, and VCs experience that. It trickles down all the way. So I think what we look for are people who really can show that they are great fundraisers. And as an early stage fund, we would love to support you until Series E, but we just can't. Our fund size can't support that. So we need to be kind of more confident that, hey, if we give this guy the ammo or this girl the ammo, or they, them, sorry, that they'll be able to run with it, they'll be able to go out and fundraise, and they'll be able to charm the socks off out of anyone.
Dara, and teams when they cross that line and when they get on your table, what are you looking at team? Because it's totally different.
So it's interesting. I was debating this in my head as I was hearing both you guys speak. I think we've had equal success, to be honest, with first-time founders and very experienced people that come from big companies. And I'm just thinking of two, our two most successful investments on the growth side. One is DraftKings in the US, which is a sports betting platform. Jason Robbins was I can't even remember what he did, but it was not sports betting because that market didn't exist anywhere in the US. But he had a ton of conviction and hustle to get it done. On the other hand, our other most successful investment is this company called Moonbug out in the UK. And it was founded by a gentleman named Rene Reckman, who was a senior executive at Disney and actually wanted to build that company within Disney, but he was literally told by Iger, if you can go find funding, go build it yourself, maybe one day we'll buy you back. And it's just proven to be very successful. So I think for us, what makes the founding team work for our investment thesis is one, a really strong understanding of how the market looks. And then within that, what is your unfair competitive advantage that you have as a team or as a founder that fits right into how this market's working and why no one else can compete where you are. I think that's probably where we look for the greatest differentiation.
Got it. And you look probably more past the founding team and more at the whole organization? Because at that point they have a product market fit, they are scaling, they have all, like you look at the holistic company at that point, right?
We're definitely looking at the holistic company, and that's a great point, Miska, because as part of our diligence, I think the first call is always with the founding team. But before we can even really get to final docs, we have met the majority of the leadership team. So that's across every single function. COO, HR, incredibly important, tech, analytics, marketing, product. We're looking for a very strong bench that can kind of support that CEO. To your point, Phylicia, fundraising is going to continue being important, or exiting and sales is going to be incredibly important. And that ultimately is what the CEO is going to be focused on near the end of our investment horizon as well. So to know that there is a strong bench underneath that can continue scaling a team is incredibly important for us.
Okay. So you're at the situation, like let's say I'm at the situation, well, not me. Somebody's at the situation where they have a founding team. We discussed it. It's a diverse team, great talents, this and that. The seed, pre-seed is there. How do I make a pitch? Like, what is a good pitch? Because like I remember from my own time, it's like, okay, now I have the idea, I have the people, and now I have to put it into a presentable form. And then you get these ideas in your head of like, I need to wow the investors, and especially through a video call. Like how do you get from I have an idea and like what is the pitch? What's a good pitch? Like if you can even walk through some of the good pitches that you've seen and heard.
Well, honestly, I think like pitching is an art, and people from different backgrounds, from different countries, they have their own style of pitching. For example, people from the US, they have completely different style. We compare people from Eastern Europe, let's say. But like the overall rule is that you need to provide a clear communication of your vision. So what exactly you're building, why you're building this product, and why investors should invest, right? So there should be a clear narrative that leads the investor to the idea why they need to invest in this company. Well, I would suggest that you don't need to focus, especially during the first call, too much on lore and characters. So try to focus on business side and product side. Be aware of the timing. So let's say if you have 1 hour of call, so it's better to have 30 minutes of pitching, and the rest will go for the Q&A session from the investor. There are some also advice, like let's say if you have co-founders and you decided to bring them to the call, so make sure that they also talk to on the call, otherwise it looks weird. And sometimes we also saw the situations when founders brought their existing investors, and so don't do it. Because like, you know, we invest in founders and we expect them to lead the process. Otherwise, it's look like kind of they brought parents to the first date.
Yeah, I was almost saying, like, bring my mother in. Like, she's invested a lot in this.
And of course, and of course, if it's a virtual call, so try to invest in a good setup. So you need to have a good sound, good camera, good light. So it's really important. And of course, post-impression is also important. So even in case you got a no, try not to be aggressive or like back for reconsideration. Of course, still you can turn it into the yes. Yeah.
Yeah. So as an investor, you probably get I know you get countless of pitches all the time.
Sure.
When the call starts, like there's a question mark. Do you pitch at the call, or do you just answer the questions? Because you would assume that an investor has read it, and now we're just going to talk about the stuff. Like, which one is it?
Well, I think it depends. Like, I think at Play, we make an effort to look at the materials you send. We'll probably ask you for your deck, you know, just so that we can spend, like, let's say half an hour actually having a conversation. But I know sometimes investors don't do that. So what I would suggest is, like, be ready for that eventuality. Like, have something that's, like, 8 slides long. You know, maximum, you can run through your pitch with them 5 to 10 minutes, right? Don't take the whole half an hour. So that way they're caught up, and you can spend the next amount of time kind of going through any questions. You know, I think we prefer to have a fluid conversation rather than have you show us slides, because we can read, or at least I hope that most of them can read. So yeah, that's what I would say. I would also say that even though, you know, one thing that we're seeing, even though technically at a pre-seed and seed stage you're supposed to be pre-product, but I think one thing we're seeing more and more is that companies or teams will come to you even with some sort of metrics. And I'm not saying that we have to have metrics to invest, but I'm saying that that's a trend that we're seeing. So obviously, if I'm a pre-seed investor, between choosing between a company that has something, shows me that they can build something and they know what, how to interpret the metrics, or there's something there, that's going to give you a leg up compared to something else that just totally doesn't have anything.
How important is, I just wanted to one more question, is like how important it is to have a growth strategy at pre-seed or seed now, like in current environment? Or like how, do you look into that? Because I'm sure there's a ton of culture decks and product decks, but what about growth?
We do. I mean, we do ask that question. Like, we're early stage investors. We know that, look, this is just like ideas and hypotheses, and the key thing that we want to see is that this is not an afterthought, because we're just not in that environment anymore. So it has to be a key part of the pillar that when you think about business building, it's not just about product, right? It's like your go-to-market, your user, everything has to come together. So what we want to see is that there's somebody that owns that piece and that is really on it, and that they're not operating on a playbook that was like true 3 years ago, but then it's like, we can't use any of this now. So we want to see that there's been thought. At the very least, you've thought about it, you have ideas. Yes, you're going to test it out, and some of them are going to go into the trash bin, and that's okay. But at least you're thinking about it, and that, I guess, gives the investor confidence that this is a team that has really thought about how to grow a business in this environment.
And Dara, in your case, like the pitch decks are probably less, but they're much more thorough.
That's right. I think just given the growth stage and where we expect the companies to be when they are pitching, there's a few basic questions that the entrepreneur or the founding team should just keep in mind when speaking to a growth stage investor. Because the reality is the investor that you're speaking to is going to report back to a committee or another team, and there's basic questions that you'll have to answer. So very simply, it's going to be where your financials are from an annual LTM and a run rate basis, what your users look like from a DAU, MAU basis, where your last round of funding was done, how much cash you have on the balance sheet, what's your burn rate if you're burning, what's your profitability if you're profitable, and what does the board composition look like? And for this next round, what do you expect for board seat, governance, rights, preference? I think these are just the basic things that a growth stage investor needs to report back to the IC. And then from that point on, it's going to be thematic and whether or not the vision kind of aligns with the hypotheses the growth fund has. But without those building blocks, inevitably you're going to be asked those questions, and regardless of kind of whether or not those metrics look optimistic or pessimistic, they're going to find out anyway. So it's just great to get it out in front, and then once you have those answers and you're like writing them out and you're preparing your pitch, there's going to be certain points that might look weak, but you can explain them away. So for example, if your cash profile doesn't look as good as you want it to be, that can simply be because the last 3 months you saw a ton of opportunities, so you're like accelerating growth. It's not because you're bad at cash management. Whatever it is, I think once you're pitching at the growth stage, just keep in mind that's what the investors are looking for. And then once you have those answers kind of clearly in your head, make sure that you're reorienting your follow-on responses to anything that might bring questions. Just have a response for those.
Got it. And Maria, do you think that as a founder, whether you're in early seed stages or you're pitching for growth funds, should the founder be changing up their deck depending on the investor?
Well, good question. Honestly, probably it's a good idea, but I don't think it's doable. Like a founder has like dozens, if not hundreds of pitches, and just to customize each of the pitch to a specific investor, I think it's too much work and it doesn't worth it. Of course, if there is like one specific investor and you want to customize a specific investment thesis to this investor, it's okay, but it's an exception. And definitely do not try to customize terms to different investors. So don't offer them different valuations and these type of things. Sometimes it happens because investors talk to each other, and like eventually they will know it, and offering different terms wouldn't play well.
Yeah, I'm going to piggyback on that. You said investors know each other and talk to each other. So how do you get FOMO? Phil?
That's a good question. How do you get FOMO?
Yeah, that's what founders are trying to do. They're trying to create a FOMO so that as many investors as possible at the same time thinking about investing, and through that, the valuation goes up.
Yeah, look, I like to Maria's point. Like, I don't think you want to start offering different terms. That we will
That's not
definitely
FOMO. That's
find
counter.
out. I think when we talk to each other, we will talk to each other generally about the deal. Like, how do you think about it? You know, but we're not gonna suddenly like, hey, let me open up my whole memo, and share that with you. So. You know, I think the best way to generate FOMO is just to get as many people in the race as possible to be your lead investor, right? Because then we know, look, and at best there's like 2 leads.
Yeah.
Not everybody can be a lead, so then that's where you want to generate FOMO, and then the rest of it, like, you know, maybe you get more of your follow-on investors in, and that's a great thing. Your round is done, and congratulations.
Cool. How about in the growth stage? Because there, the FOMO is not anymore about talking. Now you have to be showing some numbers.
Yeah, it's a great question, and it's inevitable. Like, investors really feed on it as much as we're trying to avoid it. And I would like to say that, you know, we don't act based on FOMO, but the reality is there is that kind of social pressure or internal pressure that if you had an opportunity to look at an investment and you really liked it, and then to think 6 months down the line you aren't the one that gets it, it's a very painful thought. So how you drive that as a founder or a founding team, though, has to be very organic. Because I think the thing that you want to avoid, which I think is one of the questions you had later on, Miska, which is like what not to do. The thing you want to avoid, though, is appearing arrogant. Like, the last thing a founding team wants to see from an investor is, you know, we have so many options and we can invest in anyone, like, we don't really need to be talking to you. The last thing the investor wants to feel, too, is that there's no appreciation for the fact that this is a pretty big exchange of capital and a pretty big check that we're administering to the team, so that if we get the sense that you can get it from anyone, it makes it less attractive for 2 reasons. 1, because we know we'll be in a competitive process, and then 2, because we don't feel like we can be part of that value add, and that isn't going to be an area, at least, where we'd feel comfortable investing. So the reality is, if you have a lot of lead opportunities for yourselves, you're going to feel that constraint on time, which is the things that you would say to myself as someone who's you're pitching to is, you know, like, these are the dates that we can pitch. You know, this is the set of information we've provided everyone else. You know, we can do bespoke data polls, but it might take a while. Like, that's all very real, and we can feel that. And there will be great examples too. Like, suddenly a founding team will like be in London for a week, so then we kind of know which of our competitors they're pitching to. I don't think you can easily fabricate that stuff. If you can, it's great, but then it's also very easy to identify if there isn't a lot of competition for the round.
And now we're talking more from the perspective of a founder trying to get money. But there's also the other side where the investors are trying to win the case, because when you meet the other type of a team, there's going to be several funds that want to lead and several funds that want to follow up. So my question is how do you win a deal?
From a VC point of view.
Yes, from your point of view.
That's a good question. I think, you know, lots of VCs will tell you when you meet them, like, hey, you know, we value add a lot, we're super value add. And I think how VCs win that deal is to really show, you know, that they can walk the talk and, you know, make introductions, be helpful to you, even when you are in that fundraising process and you don't have anything signed with them. And if you see that they can deliver on that value which they're claiming, I think that's a really good sign, and that's one way we think about it in terms of being supportive of the portfolio companies. You know, I think they would be, you see it in them, just being super responsive, because they know that, you know, the more responsive I am, like, the better it is, you know, the likelihood that I am going to win this deal. I'm going to try and make my IC schedules change so that I know that you're waiting for a term sheet and you're going to get it on maybe Thursday, Friday. So I got to get my IC in on like Monday. I'm going to shift it just to kind of, you know, make sure I can get back to you as soon as possible.
IC is
Investment committee. Sorry about that.
Yeah,
Dara.
I can.
Oh yeah, Maria.
Yeah, I can also add, like, FOMO is a big thing for me, and it makes my work so much stressful. You know, it's like with the casino, so you need to set a certain threshold. You should not go above, otherwise the deal doesn't make sense. But of course, how you win, you need to try to charm the founders and want them to work with you. But at the same time, for example, if I know who are the other bidders and these are friendly kind of funds whom we usually actually co-invest and we can co-lead. So it's totally fine, and I would rather go friendly and try to make a combo deal together with these funds.
For us, what I've seen that we do is if we know it's extraordinarily competitive, we actually will move on valuation, and we'll try to be creative with certain structures to make it work for the previous investors and the founders as well. So whether or not that looks like primary plus secondary, but the secondary is at a significant discount, so you can blend down the valuation, but you might give some early employees, founders, or investors a path to liquidity. That's one. Second is warrant structures. So initially, the investment looks like the valuation was XYZ, and the primary capital in was XYZ. A year or 2 years from now, we can blend down our entry valuation, or through rights. So if evaluation, and typically that ends up being one of the biggest factors for growth round investments, and it's very competitive, a focus for us, we can actually move, I would say, from a starting position, and we're ready to do so. I think the other thing, and the reality is when I think through all of our investments and the ones that are very competitive, it's a very long dated relationship. We've known the founders for over 10 years. We've worked with them in the past. So hopefully that speaks volumes to Phylicia and Maria's point of adding value. We've done it already consistently throughout, before our investment even, and we'll obviously continue doing it after. Yeah,
and then from the founder's perspective, you have to say that there are a lot of soft skills that come to play when talking to VCs, and there are certain people you click, and there are certain people you definitely don't click, and that plays a big role because as a founder, you're looking to these people as your partners, as somebody who's going to be on your board, as somebody you have to work with, and somebody who you have to take critical feedback from. So all that type of whether it's promptly responding, but also having a thorough conversation about the business, and if the VC is expanding your view, you're like, oh, that's a great partner. So there's the soft skills are quite important in the VC land as well.
Yeah.
I got last ones, and then it would be great to ask from the audience if they want to participate on something. So I have certain phrases that VCs say, and I want to know what they really mean, because I've learned what they mean, but I didn't know, and I know that a lot of people still don't know what these mean. So, Phylicia, I'm going to start with you. So,
no.
I get a reply. You're a little bit too early with this fundraise.
Oh,
what does that mean?
okay.
Should I come in later?
I'll let Dara answer what that means for a growth stage investor. I think for an early stage investor, it's unlikely that we're just going to put it at there and say you're too early. If an early stage investor tells you that, then that probably means they're just not interested, so don't bother. But if it's coming from play, I think what we will probably tell you, you're too early because there's something that's missing. So things like, for example, you've got a bunch of business leads on your team, nobody that can actually code. So that's a problem for us. Yeah. I'm not saying for other funds, but just for us. Or that we like you, but you're missing something. Because we talk about that complete founding team, right? Or we like you, but just not this space. But think about it and come back to us again. So it's not so much you're too early, but it's more like you're missing something. I'll let Dara continue.
Series A and forward, if you're too early, what does that mean?
So that is a clear no. And I would say don't even try to come back until that investor has raised its next fund, and you've shown that 3 to 4 year progress. I think the reality is I was thinking more about the question last night after we rehearsed it, and for ourselves, if it's actually too early, but we really, really like the founder, we really like where it's going, we'll stretch. We'll figure out a way to move ahead, move earlier, go lower on our check size, and we'll still invest. So when we default to the phrase too early, it just really simply means no, and no for quite a while from our fund's perspective.
Well, I'm not that negative. I think that it can mean different things, right? And I think that there are some investors for whom this is indeed too early. But of course, for some investors, it means that they have some concerns and they don't want to say it explicitly, the real reason. And of course, the investment decision depends on hundreds of criteria, and sometimes it's just much simpler for them to use this wording, it's too early, rather than to explicitly say all the reasons why they decided not to invest. And again, for us, so we invest very early pre-seed and seed stages, and for us it doesn't make sense to use this wording. And even on the website, we have this never too early narrative. But at the same time, we also have our kind of risk profile. And sometimes we see that the risks that we highlighted are higher than the potential. So we can also suggest, like, come later. Probably something will change down the road. So probably the team will be strengthened, or some metrics will appear, or you will pivot to another product. Yeah.
Okay, got it. So in plain English, it's if an early stage fund tells you too early, there probably you have to bolster your team. If a late stage fund tells you too early, you should delete their number from your phone and not call them
No,
again.
not delete them. You can go back to them in 3 years, maybe.
Maybe. How about this phrase? So this is something that came up to me when talking to some of the founders. Like, they would ask my advice, and they're like, hey, so there's a lot of interest. I just need to find a lead, because there's like a lot of these funds are interesting to follow, but they just tell me to come back when I have a lead. So Maria, if we start with you, like, what does that mean?
Again, so usually we don't say it because we prefer to lead, but I think it can mean different things. So there are funds who do not lead, and we know these funds, like OneUp, for example. But I think for some investors, it may mean that kind of they have some concerns and that they're not sure, and they need some market validation for the idea. And especially true if they don't have enough expertise in this particular area. Yeah.
Okay, political answer. Dara, let's go.
I think for us, if we actually hear that, it would be somewhat positive if we can lead. And that's because our fund mandate is to lead. So especially in the growth fund side, $50 to $150 million checks, we want to be underwriting the valuation. We want to have a board seat. We want to have governance. We want to set the rights. And we actually want to do the diligence and then pay for all of it. And then if there's room, we absolutely would take on those other investors, especially if there's like some sort of strategic angle that they could bring. So you mentioned OneUp Ventures. There's other funds that are comprised of ex-founders and ex-entrepreneurs, and we would love to have them in, or they're individual VCs that are investing almost as an angel capacity. So for us, that is super interesting. But the reality is I don't think you would hear us say something like that, because we wouldn't default to that as an excuse, because we just wouldn't be able to follow on if there's another lead investor.
So even if a founder comes back and say, hey, I found the lead,
Yep.
then you would come up with another excuse.
It's too
It would
early.
be too early.
It's too early.
All right, Phylicia.
No,
So find a lead. What does that mean?
Find a lead means, like, maybe just in your Rolodex, deprioritize them for the purpose of founders who have limited time, energy, right? And also money. You want to focus on finding the lead, because the lead will pull in the follow-on investors and they'll set the terms. It's very unlikely, typically, that a follow-on investor pool will convince a lead investor to invest when they had already been thinking not to invest, right? There are some good signals, like, you have amazing gaming angels, you have some really high-quality follow-on investor signals there that might make investor more inclined to look at the deal again and just kind of look at it in greater detail, but it's very unlikely that like a follow-on pool of investors will just suddenly say, oh my God, please take my money. But yeah, I think for some funds, definitely, like, there are follow-on investors like OneUp who are great. And if you mentioned that, OneUp said they'll follow on, nobody's going to think it's weird, because we all know that OneUp only does follow-on checks. That's fine.
And the reason for these sort of a soft nose is because, in the end, this is a very unexpected business, and sometimes a thing can happen that is totally against your hypothesis and your conviction, and you want to say, oh, wow, oh, well, these look kind of great, so welcome back. and that's why you don't want to be definitive. And also, that founder can start a new company, and they can pivot, and something can happen later on where they come back, and you still leave the door a little bit open. And that leads to my last question. How do you open up that door? How do you win the not now to here's the term sheet?
So I think it's a good question. And in our portfolio, we do have such companies, at least two, that turn a no into yes. And just the general rule, so when you get a no, don't get aggressive. So it's not the exam, right? The investment pitch. And just keep updating investors. Send them your progress reports, updated builds. Short, yeah, not so often, right? So not on a weekly basis, otherwise it will seem like spam and at some point investor will block you or just put in the spam folder. Probably, I think quarterly updates are good. Yeah, and eventually investor can decide that it's a good opportunity for them.
Completely agree. Regular follow-ups, quarterly, perfect cadence. If you feel comfortable enough and you have a strong enough relationship with the investor, feel free to make asks. I think investors love to feel helpful. So if, for example, you see that there's this portfolio in the investor's fund, can I get an introduction because I think I can sell into them? Investors would love to make that happen because it could be a two-way street. Similarly, even the other way around, like if your friend's fundraising and you want to introduce that interpersonal dialogue, that's how you start shifting it from like a pure transactional, like please invest in my company, to a more personal relationship, and that will pay dividends over time. And I'm just thinking of a few companies in your portfolio, Phylicia, that have regularly followed up with us, and like we're getting there. Like we talk about it every IC, and
great. So
they're
not sending you weekly updates.
Yeah, they're quarterly, so they're very, very good.
Or essays.
Or essays. Yeah, don't write an essay rebutting every point, because that's actually not helpful. I think the main point is like, if we've given you specific feedback, and if you think that is actually something that's helpful or valuable or actionable, and take that on board, don't be defensive, keep the door open for yourself as well. And then, when you come back to us with updates, it's like, hey, that was really great feedback. I've actually taken steps to address that, right? I filled this gap. I've made some changes so that my cap table doesn't look so problematic anymore. That's great for us because it shows us that, hey, this guy is open to feedback, this girl, or they, them, are open to feedback, and that they're people that we feel like we can work with in, like, over a multi-year horizon. Like, we're not every point of feedback is going to be an argument.
Yeah. And that happened in my situation as well. A founder said, not now. And I was like, why not? Because a co-founder, we need somebody who's strong at this to believe in it. And then maybe a couple of months later, how about this? And they were like, yeah. And then that's it.
Yeah.
And so yeah, those things actually happen in my own experience. Yeah. So are there any questions that you would like to ask now, or once people, please? Just yell.
We can hear
I'll
you.
repeat it. The unfair advantage of a Turkish ecosystem?
That's a great question. I think that your unfair advantage, and I've seen this, I think, in a number of Turkish teams, is that you guys just keep going. And you're not like, we've seen it in other ecosystems sometimes. It's like somebody tries to fundraise and it's like, oh, no, okay, and then that's done. And then you meet them 1 year later, and you're like, what happened? And they're like, oh, yeah, no, nothing, basically. And then they come here, and then it's like 1 year later, and you meet somebody, and they're telling you, they've done this, and they've tried that. And I think it's that willingness to experiment, especially in this kind of a climate and ecosystem. The willingness to try new things is definitely an unfair advantage. And a lot of people don't do that. And honestly, in this environment, I think if you don't do that, you will die.
I think what I've seen is that it's an extremely, extremely aggressive entrepreneurial environment. And it's, from my perspective, very risk-loving, which is fantastic. I mean, and then you guys also have a history of exits. So I think Peak and Graham gave you guys the examples of what is possible. And then companies like Dream and how absolutely aggressive they were with their spend and their building of the org, and their vision is unlike anything we have seen in the past 5-6 years. So it's unbelievable. And even just in this week of visiting Istanbul, I got the chance to meet with Codeway. And like what they're building is, no one else is building anything like that besides maybe Bending Spoons in Italy. So for all of that to come from this city where not actually a lot of investors travel to is quite unbelievable. The fact that Google is investing so heavily into this ecosystem is also fantastic. So the opportunity is phenomenal for Istanbul. And I think it actually, at least for me, when I hear that a founder is from Istanbul or building their company in Istanbul, it's definitely a positive. So it's something that everyone here who's a founder in Istanbul should lean into.
Yeah, I think that there are several reasons. One of them is that, like Dara mentioned, so there is already an existing ecosystem. So there are many big companies, and there are lots of talent in the region, and kind of many teams in these big companies. They're ready to split off and to launch their own startups, and they have this experience. And of course, many people, they just encouraged by the success of these big companies. So they also want to kind of build a multi-million games. And another reason is that like the economical system in the country, probably on the personal level, it's not the best thing, but at the same time, I know that you have like high inflation, and many people, they tend to build kind of international businesses that have international source of revenue. And kind of games, probably one of the best type of businesses for these purposes. And the further reason is I know that the Turkish government is kind of supporting many gaming companies, so there is a special incentive on user acquisition, so there is a big payback kind of amount. Yeah, so I think this all contributes to the kind of industry growth.
I'll add one more thing. So I agree, hungry, very smart, but one thing that's working with Turkish founders, many of them are very humble at the same time. And these, I'm talking about humble, people who are very successful are still very humble. They always are very eager to hear any kind of feedback. What am I not seeing? What am I not getting? Despite like getting straight A's with everything, is like, what do I don't know? And I think that is a quite unique characteristic.
Yeah, that's a great one.
Any other questions or? All right, I think that was a great question. Thank you so much.
Thank you.
Thank you.